Home prices right here in San Diego fell. Insurance costs may be on the rise, and we have some new predictions for mortgage rates. So let's get into all that right now. So the seller's market is cooling. San Diego's home prices fall for the first time this year. I'll show you what's actually happened throughout this year. San Diego County's median home price was $889,500. This is including single family homes, condos, townhomes, all that kind of stuff. So, and this was from August. They were down 1.2% from July. Now that was looking at data from Adam Data Company. This is from our actual MLS, and the story is pretty much the same. And that went from July to August. Now we're actually in, the newest numbers came out in September. We're at the end of October right now. We should have those updated numbers to see where we are. And yes, that did definitely happen. From July to August, home prices did fall. But we also did see a slight downtick from April going down into June, just a little bit. So it wasn't technically the first time we've seen them fall this year, but we did definitely see them from July to August and then down a little bit, sitting at $890,000 right now. Now, home sales remained at historic lows in August, which somebody did mention in one of our previous videos about home sales. I didn't mention that home sales were down. We're not where they were in the past few years, which I'll show you here in a sec. As far as the number of homes, they're up a little bit year over year, but definitely not where we have been in years past. So home sales remain at historic lows in August, but did pick up slightly. There were just over 2,400 sales, up 2.4% from the same year. And it was still the second lowest sales for August, typically a busier month in records from Adam and Cotality going back to 1988. So looking at home sales, it's actually down a little bit even more in September here, just over 2,000 home sales. And you can look back to the previous years, September, a little bit above that, September 2023, a little bit above that. And then as we get into September 2022, a little bit below that. But if we zoom out a little bit further, we could see we are a little bit above the last few years. You can see this little section down here from about 2023 on. The number of closed sales right here in San Diego is super low. When we go back to a more normalized time frame before the 2020 pandemic, you can see where we were sitting, and I'll show you some of those numbers right here, just to give you a little context of where we have been in the past. So 2019, we were over 3,000 homes closed in September. As we go back to September of 2018, we had 2,600 homes. September of 2017, 3,000 homes. So yeah, we're just above 2,000 here, but all of these timeframes, when we consider it a more normalized market, was much, much higher. So a lot more closed home sales back then. And Mark Goldman said the seller's market is cooling, but he wouldn't go so far to say that it was a buyer's market, where supply greatly exceeded demand. Yet he pointed to the time it's taking to sell homes and lack of interest in open houses as signs that sellers may be losing the edge. So just for a little context, yeah, we're not necessarily in a buyer's market. Let me give you an example of some buyers we're working with right now. We actually missed out on 2 properties. They're actually in escrow on a property right now. The first 2 actually did have some competition. The other potential buyers that were writing offers were a little bit better than ours, not necessarily above list price, maybe a few better terms, maybe a few waiving of contingencies, but there is still some demand. It's not necessarily a bidding war. The home that our clients did end up getting in, they got in right at list price, even though there was a few other offers as well. So there's still competition out there, but I went to them with the open house last weekend, and there might have been one other crew in there, but comparing it to a few years ago in open houses where it was just packed. I mean, going through there, it was a madhouse. When we were holding open houses, it was crazy. When we were going to open houses with clients, it was crazy. Right now, there's still demand out there. You're just not seeing it in the open houses. You're not seeing it in certain price points in certain areas. Some are a little more aggressive as far as price points and offers. Like I always say, it comes down to your specific situation as far as what you're looking for, your price point, all that kind of stuff. So the median time for San Diego County homes to sell right now is 40.5 days in August, according to the Redfin Data Center, and it's the highest point in more than 4 years. In early 2022, homes stayed on the market 8 to 12 days. So let's take a look at the days on market here. So we are up over 25% compared to September of last year, which was 28 days. Now we're at 35 days. As we go towards the end of the year, you'll likely see this continue to go up as we do in every year. Going towards the end of the year, you're likely going to see longer market times. But we also mentioned, yeah, there's some opportunities for buyers because a lot of sellers selling during this time are definitely motivated. But right now, 35 days. When we were in the bottom of the bottom, May 2022, we were looking averaging 11 days on market. And yeah, I mean, during this time, it was crazy. I'm glad we're not in that time. If you're a buyer out there, you're probably glad you're not in that time. As a seller, you probably, you had a ton of offers. You had a ton of negotiating power. That's changed a little bit, but it's not necessarily fallen off a cliff. And then right now, buyers have more homes to choose from than a typical tight market. So there are about 7,000 homes for sale in August in San Diego County, compares to about 5,700 the same time last year, 3,600 in 2022 and 5,800 3,600 in 2023 and 5,800 in 2022. And we can see that right here. So September, it did drop quite significantly. In August, when they did write this article, it was just over 7,300 active listings. Now we're at 6,500. So a steep drop off, which you typically see at the end of the year. Once again, you see market times for homes on the market go up, and then typically you see the number of active listings go down as not a ton of people it's not really the busy season where you see a lot of homes coming on the market as you're ramping up towards that spring and summertime. Like you can see right here, happened this year and in many years past. So we'll continue to see this trend go down, but we are still a little bit above where we were last year, because last year's peak was actually in September, about 6,400. Now we're already on a downtrend. So a recent drop in mortgage rates has been celebrated by real estate agents in the hopes it could spur sales. Typically, as they were in that elevated, above 7%, as we approach that 6% and going to where we are right now, we were expecting that we would see a lot more buyers out there, which we have seen. If rates are still in the high sevens, we probably wouldn't have as many multiple offer situations as we had with these particular clients in that price point. But as rates come down, I'll show you where they are right now and where they are expected to be in the future here in a little bit. But we'd expect closer they get to that 6, especially if we could drop under that 6 going into next year, we might see some more buyers come off the sidelines and re-enter the real estate market. Now, with all that said, a monthly drop of 1.2% to a median of 889,500 is actually up annually 1.7%. So even though month on month we're down a little bit and continuing to fall as kind of seasonality as you go into this part of the year, you're going to see home prices typically drop down a little bit as you go towards the end of the year. But from January, where we were sitting at 876,000, we are up a little bit, up to 890,000 right here in San Diego. And as with all this, it really comes down to like I always mention it, it really comes down to what you're looking for, what areas you're looking at, what price points you're looking at. This one says San Diego County home prices fell on average of 3%, but one city hit a record high. So one coastal city right here in San Diego, going by the Zillow Home Value Index, is down a little bit. So Carlsbad had the highest increase in the state and in San Diego County, with the average price reaching nearly 1.24 million last month compared to 1.19 million in September 2024. So a 4% increase. Rancho Santa Fe saw the second highest, a nearly 30,000 increase from the same time last year. And other cities saw slight increases or remained level, including Bonsall up 1%, Alpine, Fallbrook, and Encinitas just changed a little bit. As we're going into here, Carlsbad the biggest, Bonsall up 1%, Alpine, Encinitas down 5,000, just call it 0%, just call that a wash. Coronado down 1%, even if you're up in Temecula or Marietta, down 2%. And going down to Lemon Grove, down 2%. And so as we're keeping an eye on the market, if you guys want a specific update for your specific zip code and a quick little breakdown, hit that first link right down in the description, right down below, and we'll get that to you. We just had somebody actually fill that out last night, got that to him this morning. Full breakdown on the area, give you a little bit more insight into what's happening in your neck of the woods. If you are a seller, and if you are a buyer, what area are you looking in? Just pop in your zip code and we will get you that full report. Now, before we get into potential insurance costs rising right here in San Diego, let's check out what's happening with the mortgage rate. So Fannie Mae and the Mortgage Bankers Association agree most of the mortgage rate relief is already behind us. The average 30-year fixed rate mortgage tracked by Freddie Mac is 6.19, down from 6.54 a year ago. And many economists believe that most of the short-term mortgage rate compression is already behind us, meaning we are kind of where we're going to be for the next year or so. So here's the forecast for the 30-year average fixed rate mortgage. Mortgage Bankers Association actually has us a tick up from where we are right now, sitting at 6.4%. Fannie Mae has us dropping down to about 5.9% by December of 2026. And if we look at currently where we are, we're at 6.13%. So starting right over here in the beginning part of October, we started to see a drop off, kind of coming down, going below where our just almost to actually right to the other low that we saw back in September. Now we're sitting at 6.13% right now. So the trend has been down. So what if both of these expectations are wrong and let's say mortgage rates fall more than expected? What happens then? Number one, there's a potential wild card, an economic slowdown. So if joblessness were to climb faster than anticipated, or if the economy were to meaningfully deteriorate, that could put additional downward pressure on both treasury yields and mortgage rates. In that scenario, mortgage rates could dip more than the baseline forecast suggests. Second off, the mortgage spread, which represents the difference between the 10-year treasury and the 30-year fixed rate mortgage, usually over the last, you can see it right here, since 1972 has averaged 176 basis points. So 1.76% difference between the 10-year treasury and the 30-year fixed rate mortgage. Last week, the spread stood at 218 basis points. So if that spread, which widened when mortgage rates spiked in 2022, continues to compress or normalize to where we have seen that long-term average, it could help also push mortgage rates down, even if the 10-year treasury just held steady. But I like this last line. One last thing. Mortgage rates forecast should always be taken with a grain of salt, at least to some degree, because predicting long-term yields depends on accurately anticipating inflation, Federal Reserve policy, and the broader trajectory of the US and global economies, all of which are notoriously hard to get right. So as with any prediction that we show you here or that we are bringing up and highlighting, take it all with a grain of salt and really focus on what you are trying to do, whether it be buying, whether it be selling, whether it be investing right here in San Diego. Kind of focus on your goals and what's happening right now within your time frame. So are you going to buy in 3 months? Are you going to buy in 3 years? Things can change drastically in both those time frames. So focus on it as you get closer and really put that plan together. Planning is one of the biggest things when you are thinking about buying or selling. Make sure all that is in order so that when you are ready to roll, you are all set, you're well educated, and you kind of know what's going on for your specific situation. And now if you are a homeowner here in San Diego or looking to be, your California Home Insurance of Last Resort seeks a 36% rate hike following the January fires. So the California Fair Plan, the state's home insurer of last resort, is seeking about a 36% rate hike. It's largest in years following billions of dollars losses incurred in the January fire. Now here's something interesting. The rate hike would hit individual homeowners unevenly as many experience greater increases and others seen decreases if they live in neighborhoods that are not prone to wildfires. So it's not necessarily going to go through at this percent. If approved, it would easily top the increases of 20.3% in 2019, 16% in 2021 and 2023. However, in 2023, the rate hike of 15.7% was cut down by the insurance commissioner from just almost 50% that they initially sought. And this isn't just for the FAIR plan, as the dispute has been playing out over a request by State Farm, the state's largest home insurer, for a 30% rate increase. So it could potentially be more than just the FAIR plan. And so this will obviously likely affect a lot of homeowners, but as you read, it can also benefit you if you're not in one of those high fire zones. But right here in San Diego County, there's a lot of high fire zones, and we've seen it a lot working with clients out there as far as the actual cost that some of these providers are charging. We just had a home sale up in Carlsbad. Our clients had lived there for a while. It wasn't a high fire zone, but their insurance provider hadn't dropped them. They were paying about $2,500, maybe $3,000 for insurance. When the new buyers came in, that nearly doubled to about $5,800 to $6,000. one of those quotes was including the FAIR plan. They got about 3 different quotes. So in every situation, whether you are a buyer or a seller, there are solutions. It just comes down to pricing. It depends on where you are located and, are you in a high fire zone? A lot of times you won't know that until you get disclosures, and we always recommend talking to an insurance provider. You could do it before you go into escrow. You could do it right at the beginning as you are starting your inspections and going through the contingency period, and just get a good idea of what that will potentially be as you are purchasing your home. So it's not necessarily a roadblock, it's just a hurdle that we are seeing some home buyers have to go through. And so as you guys are thinking about buying or selling, one of the best things to do is know what's going on in your neck of the woods and your specific situation. So if you do want to get a recent update of what's happening in your neck of the woods, that first link in the description below will get that personalized market report out to you. And also, if you are thinking about selling, you want a quick snapshot of what your home is worth, we also have a free home seller report right down below as well. So just pop in your info there and we will get that taken care of for you. I'm Chris Erickson. We got a local real estate crew right here in San Diego, and we got your back when making the move here in San Diego.